Welcome to another installment of Fides Financial Moment with Mark Gallo and Dr. Chris Rand.
How you doing today, Mark?
We're doing good. You know, the purpose of this conversation today is to discuss a little bit about what we're seeing with the markets. I know there's a lot of questions about what's going on with the markets. And, you know, utilizing technology the way we do, let's go ahead and blast it out to everybody.
Sounds like a plan. You know, I wish we were coming to you with a little better market conditions than we've had over the last number of years, but it's been a rough first half, wouldn't you say?
I was like to say, you know, market conditions like this is what keep us employed. You know, I hate to say it, but obviously during times like this, it's important to kind of be steadfast in the way that you approach your finances, and now more than ever, I think it's really important to go back to that.
Sure.
Well,
Sounds good.
I thought I'd start today talking a little bit about where we've been and where we're going. I think it's important to understand kind of how our economy has been through the ringer. We started back in 2020, where the entire world was shut down from an economic side.
Yep.
Everybody stayed home. Important to do that kind of whole thing. Well, in that process, our federal government decided to give us a bunch of money to make certain that we were still
Massive stimulus.
Stimulus. So we gave a bunch of people a whole bunch of money, and then what we did is the great American public that we are, we spent a bunch of money. We bought a bunch of stuff. And so what we're coming across right now is we have, as a society, we bought a bunch of stuff and we didn't have anybody making anything. I don't know if you remember back in middle of 2020, trying to buy a couch. It was very difficult to do.
There's so many different items that were on backlog for, you know, days to months to maybe even 8 months, 9 months. We've talked to actually two different electricians were telling me they can't get some sort of important switch that's needed in the commercial side.
Yeah.
And it's still on back order for a number of months. It's been can be very challenging.
Well, this is what happens when we shut down our economy. We don't have anybody to build anything. But if we continue to buy stuff, it just created a supply and demand issue, which has reared its ugly head. As of February of this year, we started looking at a hyperinflation kind of situation. Would you agree?
Yeah, and I think everybody realizes at this point that we're seeing a lot of inflation. I think the cost of a gallon of gasoline is probably the one thing that everybody knows what the cost is. Even my children driving in the car know what the cost of a gallon of gasoline is, because you drive down the street and that's the one item, the one commodity that's always out there, right? Always has that price. And gas costs have gone up incredibly, but it's not just gasoline. It's across the board, to your point.
Bread, milk.
Yeah,
eggs,
and it's it's being driven by a bunch of different factors. The war going on in Russia and Ukraine is certainly not helping that. There's an issue with commodities as a result of that, and then of course oil prices have gone up even higher as a result of that action. We're dealing with a whole bunch of catalysts all at the same time. We're in the middle of we're coming up on our midterm elections here in the U.S.
I term it the wacky season.
The wacky season. With this high inflationary environment, the Federal Reserve has drastically increased interest rates on a path to try to calm inflation. The COVID issues in China is still going on there, where they have shut down their economy a couple times now. And so that's creating supply issues, which are probably additionally having an impact on inflation.
Let's talk about why the Fed raises rates, right?
Okay.
I mean, so when you look at inflation, it's traditionally it's a problem because of traditionally not enough supply for the amount of demand that's being out there, right? Just imagine if you had something that everybody wants, you can charge more for it.
It's also called too much money chasing too few goods. Same kind of concept.
Right? And so what we're dealing with right now in our economy is we can't really increase supply that much. We've managed to farm a lot of that out to other places. I mean, heck, China just reopened again. So we can't really get a whole lot more on the supply side. So the only way the Fed has to control inflation is to lower demand.
Yep.
And so the only way that one of the only tools they have in the toolbox is to make money cost more money. And if money costs more money, then the theory, it's all theory, is that people will slow down their spending rates. And we're going to see that in housing. We're going to see that across the board, cost of credit cards, you name it.
Yeah, we're already seeing that in housing, right? Mortgage rates have gone up drastically over the past month or so. Sooner or later, that's going to make housing less affordable, right?
Yeah. And so that's an issue, and that's how the Fed is doing that. So now what they're trying to accomplish by raising rates on their meetings is to show people, listen, money's going to cost more money to borrow, and in turn, it should start to slow down the spending, which will then, we hope, will lower our inflation. We were at 9.1 at the most recent report. Now, I don't think that the stock market is sitting back waiting for us to get to 2 before they recover. I think we just need to see a negative movement on inflation. If it goes from 9.1 to 8.7, I believe that the stock market will rejoice in said compensation.
Well, investors would possibly see that as a positive effect. So
yeah,
to your point, investors, which drive the stock market, they are looking at what earnings are going to be 6, 12, 18, 24 months down the road.
Yep.
So if there are a sign of inflation, let's just say getting under control and slowing, that likely would increase earnings down the road. And so investors may see that as a positive thing and the markets may start to recover. Let's take a step back though to talk about the Federal Reserve for a minute. And I think a lot of people get kind of confused. They might say, well, why is the Federal Reserve trying to create a recession? I wouldn't say the Federal Reserve is trying to create a recession.
Nope.
They have a dual mandate. It's to price stability and maximum employment is what they say. So what does price stability mean? As we want to keep inflation at a certain level. Their target inflation rate is 2%, right? 9% is considerably higher than 2%. And so we know that they know that we have a problem and we need to slow that down. If they raise interest rates too high, too fast, go too far, they may create a recession. And a recession usually means that would go against their second mandate, which is maximum employment. And that might mean that people start to lose jobs through layoffs. And so it's this balancing act. It's almost like they're on a teeter-totter trying to raise interest rates far enough to slow down and create good price stability, yet not so far that they create a recession. Unfortunately, historically, the Federal Reserve has not been the, maybe people would say, they don't, let's just say they don't have a really good batting average. Maybe is the best way to describe that. And so frequently they may go a little far and then have to back off.
Which is okay.
But we find ourselves in an interesting employment situation, I think, today. I was having physical therapy for my ankle surgery this morning, and therapist and I were talking about the employment situation, where it's so many stores that you go into, or restaurants, and everyone's hiring, right? And it's like, where did all these employees go? There are a tremendous amount of job opportunities open right now, and so maybe as the Federal Reserve increases interest rates and as we start to see job losses, it's not so bad that it creates a job recession.
At least a parity, hopefully. Right now we have 2 jobs for every 1 person looking for a job, and so if we can at least get that to 1-to-1, that'd be fantastic.
Could certainly be heading in the right direction. I think our clients are most interested in though is what about the markets? They're down a lot. We're in a bear market in the stock market. The bond market has hit, depending on what segment you look at, is let's just say down over 10%. A massive negative move to the bond market. I think it's that stability time period that you talked about a few minutes ago, where whenever investors feel that we're starting to see that trend in the right direction, then the markets will make their turn like they have historically.
Can I tell you, I am excited about one thing though.
What's that?
I'm excited about when we go through this bond process. I mean, the bonds traditionally are paying, they were yielding 1.5% because the interest rates were so low.
Yeah.
When we go back and reinvest our bonds, say 18 months from now, I think we'll be in a 3-4% bond environment.
Yeah, it's been a
which would be fantastic.
Exactly. From a yield standpoint, it's been horrible, right?
Yeah.
And so we might actually get decent yields coming up here.
Which would be amazing. I would say a lot of our clients are sitting anywhere between a 50-50 mix of bonds and stocks to 40-60, 60-40, and to be able to see a portfolio be able to get that kind of yield from 40 or 50 or 60% of their portfolio is a fantastic thing long term for them. Yeah. But unfortunately, in the short term, we're dealing with some problems.
Yeah, it's a little bit of pain in the short term.
Absolutely. So. Well, this has been the Fides Financial Moment. Mm-hmm. I appreciate everybody for watching this. If you have any questions, if you want to go over your own personal portfolio together with us, if you have any questions, feel free to give us a call. We're available whenever you need us. Thank you very much for your continued support.